Welcome to our monetary policy special. For a status quo policy, the latest monetary policy has had a terrible impact on bonds, with yields rising nearly 14 to 15 basis points on the benchmark 10-year bond after the announcement of the policy. Even crude prices and US yield spike didn't move the Indian bond yields as much as the announcement of the policy. Now, what did the RBI do to trigger the bond bears? It said that it will sell bonds through open market operations, or what are called OMOs. Now, that was the only blow. You know, when the RBI sells, it withdraws money, and so liquidity is tightened. For the rest, the policy, especially for the stock markets, was quite bullish. If you recall, it kept interest rates unchanged, gave a higher than expected 6.5% growth forecast even for next year. And it didn't raise the CPI forecast for the current year. It's only raised it for the second quarter. In fact, for the next year, the Reserve Bank has a very benign inflation forecast of just 4.3% by the time we come to the end of the year. Let's hear out the governor, and then we have a battery of specialists to analyze the policy.
You have not given us an idea whether you will do an OMO auction or what you have been doing all these days, you know, some quiet screen-based buying.
This will be done through an auction process and not through the NDS home platform. This will be an auction process. We will notify it and then we will undertake the auction. We will undertake the operation. I would like to emphatically reiterate that our inflation target is 4% and not 2 to 6%. Our aim is to align inflation to the target on a durable basis while supporting growth.
That was a punchline. And to analyze the policy and the state of the economy, I'm joined by Mr. Dinesh Kara, Chairman, State Bank of India, Samiran Chakrabarti, Chief Economist, India, Citibank, Mridul Sagar, Professor I.M. Kozhikode, former MPC member, and B. Prasanna, Head Global Markets Group at ICICI Bank. Since the bond market is the biggest casualty, Prasanna, the first question squarely goes to you. I mean, is it just going to remain under this burden of, OMO any day now, OMO any day now? What's the kind of range you are looking at? What's the psyche of the bond market now?
So I think, Latha, it was always expected that RBI will have to sound a little bit hawkish because of the global developments. To that extent, there was a belief that it won't be a complete status quo in terms of stance. But clearly what transpired was not something most of us did not expect. The fact that the governor will actually speak out the words that he will be doing OMO, and also the fact that he will do it through an auction mechanism and not the screen-based buying that I think you rightly mentioned. So I think from that point of view, it now leads to a lot more uncertainty at this point of time, because we really don't know what is going to be the size. Of course, we can do our calculations that if they want to go to a core liquidity of zero by end of this year, end of this financial year, they might have to do something in the region of 50,000 crores. But I don't know whether that is the number they are having in mind. What is the method, in the sense, what is going to be the size of each auctions? What is the timing of that? So to that extent, I think, yes, you're right that there is a kind of a sword hanging in front of us. And hence, when investors actually invest in auctions, they are going to be a little bit more conservative and will actually demand the uncertainty premium that I was talking about.
Okay, so range would be for now, for the 10-year?
So, yeah, it's a little difficult because you have to figure out when and how RBI comes in, how serious are they with respect to the announcement? Was it just meant to, drive up yields with not followed by an actual announcement? Those are the things that we will have to watch out for. But having said all of that, I would say a 7-quarter to 745 kind of a range should be there for this quarter.
Okay. Well, Mr. Khara, now squarely to you, what is the economic impact, the real economy impact if yields are this high? Are you expecting cost of capital to rise for corporates? And will there be, higher rates charged, for instance, for unsecured loans, for loans which are not tied to some repo or something?
Again, I would say that much of it will depend upon the liquidity in the system. As on date, of course, there was a situation where there was a deficit in the current liquidity. But I expect that with the relaxation of the ICRR from tomorrow onwards, I expect that about, as of yesterday or today, it was about 34,000 in the deficit. But we expect that some cash will get released, with the relaxation, about 54,000 odd crores. So that will bring in some kind of a surplus liquidity in the system. And again, I would say that the government spending will also bring in the liquidity in the system. So much of it will be a function of the liquidity which will be there in the market. So that will be something which will be driving the short-term interest rates. That's how I look at it. And eventually, the liquidity in the market also impact the sentiment. So that is also a reality which you have to be cognizant. So I think we'll have to wait and watch for a few more days to really fathom how the market is likely to be.
At the moment, if you have to, I don't know what is your last, target or guidance in terms of loan growth. Will you moderate it?
No, I think loan growth, considering the fact that we are getting into the busy season, so I expect the loan growth will be around the same level. There could be marginal variations here and there, but I don't think it will have a very significant impact on the loan growth.
Okay, well, clearly by RBI standards, no, because they have only given a bullish forecast for growth. Coming back to you, Mr. Khara, and first from all of us here, many congratulations. It is now official of the extension of your tenure, so many congratulations.
Thank you very much.
Okay, but now to the big point, the OMO announcement and the pushing up of yields. Mridul, we tried our level best to ask the governor whether this is in response to the rise in yields and whether interest rate differential is a concern. How does the RBI think about this? Would you relate the OMO to increasing the yield differential between India and the dollar rate, between rupee rate and dollar rate?
So, Latha, I have been saying this earlier also, that this is just one of the several factors which come into play, and the monetary policy is essentially glued to the domestic factors. And this is what Governor also clarified in his press conference times and again on this issue. So it's not the interest differential that is sort of forcing RBI to raise the rates. I think we are missing the basic point, what he has been saying now for the third policy in succession, that target is 4%, not 2 to 6%. And he was very explicit today. And the effort is clearly to add conviction to this by sort of taking some action on the liquidity front to keep inflation down. And that's the primary objective here. So if you see where the real rates are, if I see the current inflation rate, normally we should see expected inflation rate, and expected inflation rates are always lower. So you could always argue that real rates are in positive terrain. But the deposit real rate on the current basis is still slightly negative. And we have seen on a national level saving rates fall, financial saving rates fall. And these are some of the...
See, Mridul, the answer to that should be to raise the repo rate. If you're that worried about, deposits, isn't, OMO the route, liquidity the route? This seems to give the impression that you are killing a different bird with a different stone.
Not really, Latha. See, these are a battery of tools and they can be used in conjunction. So while the Tinbergen principle does apply, and he made a reference to that,
yes, he did.
His statement, I think he has also made a reference to the taper tantrum. And if we remember clearly, the route was to siphon off liquidity and raise the short-term rates, keeping the policy rate in track, but the sort of real rate on the MSF part went up by 300 basis points.
Okay. Fair enough. Samiran, what would you say is the trigger for this OMO announcement? Liquidity squeeze, yes, but OMO is big.
Yeah, we were at a very interesting juncture where there were two different signals coming from the banking system: frictional liquidity and the durable liquidity. So part of the market was thinking that because the banking system frictional liquidity is relatively tighter and we are entering the festive season, the RBI would not tighten liquidity. Whereas RBI is probably looking at the persisting surplus in durable liquidity. And in fact, with tomorrow's ICRR, this number will probably go up even further. So that's probably prompted the first move. But at the same time, it is very weird to think that RBI did not know that after this announcement, yields will not go up. I mean, that was anyone's guess that it would definitely go up. So from that perspective, one can say that RBI is tolerant to the fact that they will allow some bit of yield up move. And that could be because another point that governor has been repeatedly mentioning, which is incomplete pass-through of monetary policy actions. So maybe this is RBI's way to ensure that that incomplete pass-through is relatively more complete through, if at all, through the bond market route, raising the risk-free rate, and that getting translated into higher lending and deposit rates. But it suffices to say that this fear of the RBI action would ensure that even if there is a lot of inflows around that bond index inclusion time, the yields, fall in yields will be more graduated unless by that time the macro situation changes quite drastically.
Okay. Well, in a word, will you say OMO was triggered by the interest rate differential argument?
I don't think that is the situation right now because we are not that dependent upon the debt inflows. But yes, going forward 6 months down the line, that could also become an important driver.
Mr. Khara, do you notice the way exporters, importers behave? That if the risk-free return is 5%, do they behave differently? I mean, I know it's too much of a micro question. I'm asking a man who's running the bank, the biggest bank. But do they behave differently? Do they rather not bring the money in and leave it in treasuries?
No, actually, on that particular front, because this year, the trade, particularly exports, are not as strong as we had seen in the past 1 year or so. So I think we don't see any such trend, but yes, we have seen generally the exports are tapering down, and it is essentially on account of the global scenarios.
Okay, so more the real economy situation. Not the interest rate differential. Prasanna, your thoughts? Are importers behaving differently since the yield surge, or for that matter, exporters?
Yeah, so I'll
for that matter, remittances.
Yeah, I'll just add on to what Mr. Khara has to say. So I think the fact that you have US short-term yields at 5.5% and Indian yields at just around 1.5% higher, at the margin definitely discourages exporters from bringing in their dollars. So I think that is definitely there. And what is interesting is also that the fact that the Reserve Bank has been quite active in intervening and preventing volatility of the rupee on either side also means that in a low vol environment, the incentive to hedge by way of paying a premium in case of importers, even that is actually reduced. So actually, we are seeing customers on both sides not really wanting to, the funny side of it is both the sides not wanting to really hedge as much as what we have seen earlier. But besides that point, on your question on the OMO, the need for it, very quickly, Latha, I think there are two ways to look at it. One is the RBI didn't know that the collateral impact of a liquidity suction mechanism would lead to so much of higher yields on the bond side. But the other way to look at it is they knew it very well and they wanted to, engineer it as well. So I would rather believe the latter, because we know that the RBI is very, very deft in managing a lot of multiple different pressures. So they probably thought that it's better to be safe at this point of time with a higher term premium than lower. Like you rightly said, it never reacted to all the various things that happened earlier. Maybe they were uncomfortable that bond deals were absorbing all the negative news from the global markets.
Okay. Yeah, that makes sense. And surely kudos to the Reserve Bank and the way they smell out everything and manage to surprise despite the best analysis that we bring to the table. A quick break, and thereafter I want to ask you all about this extremely confident growth forecast, and I would say a very confident inflation forecast as well. Back in a jiffy.
he's at?